Discounting, compounding, present value, future value. Hi guys and welcome to Mentor's YouTube channel. My name is Alan Arvindan and we're back again with another video, but this time we're talking about discounted cash flow calculation. Okay, so we're talking about discounted cash flow from the perspective of understanding the concept first instead of directly jumping into making models, because usually the mistake that people make while understanding these concepts is they try to understand this solely based on equity models, and that is where the problem arises, because later on when they're trying to apply it into different scenarios, like let's say realistic valuation, they are absolutely unaware of the fact that the concept remains the same, right? So what we're going to do today is that we're going to be focusing first on the basics, of discounting, compounding, present value, future value. Then we're going to be talking about the concept of perpetual cash flows. Moving on from that, we will also talk about what to discount, because knowing discounted cash flow is fine, but what do you discount, right? So and we'll try to do a calculation of that, and then finally at the end we will do a calculation of a real model values and try to find out the equity valuation of the company using the DCF. Right? So let's start with the first concept of future and present. Right now, if you understand the first sheet out here, and I've attached a template with in the description box, so you can actually download this and practice as you go. And be aware that there's a disclaimer that the video is going to be a little longer because it's going to take me some time to go through phases. So you are absolutely allowed to skip through contents which you might already be aware and directly jump into that session. Okay, so let's start with the future and present kind of concept. Okay, so very basic concepts, very basic examples is what we're going to take, so that you understand what are we exactly doing in terms of discounting. Okay, so I've taken three examples out here. If you can see my sheet, I am taking the examples of Nifty 50, a simple house which we talk about, or maybe Bitcoin. And we are saying that, okay, there's a concept of value. So the current market price of these assets are 16,889 today. Let's say a value of a 2 BHK house is about 0.85 crores or 85 lakhs. And the Bitcoin current market price is about $39,730. Alright. Let's say somebody says that, okay, the expected future price of Nifty, which is the index of NSE representing the top 50 companies in India, is, let's say, 30,000. So, and let's say the projected value of an asset, like a real estate asset, goes from 0.85 to 1.5 based on whatever assumption that the person has taken, right? And similarly, somebody says that the Bitcoin value will increase from all the way from $39,000 to all the way up to $5 lakh, right? So we're talking about the expected future. Now, the current market price and the expected future price have a lot in common in terms of understanding the basic question that we're trying to answer. And the question that we're trying to answer is, what is the value that you are ready to pay? Okay, so for example, if I talk about Bitcoin, since you might be able to relate to this a little easier, is that although the value of Bitcoin today in the market is $39,000, but that has no meaning unless and until I have an expectation of the future. So if I have an expectation of the future that the value will increase significantly, my real price that I would like to pay for it will significantly change. Because if I don't expect this to go to 39 to $5 lakh, then probably my real price or my intent to buy is not going to be there. Right? Similarly, if let's say we talk about the current market price of a house is 0.85 crores, and somebody is telling that, okay, or maybe we have calculated that the value can increase to 1.5 crores in about 7 years, then what price I will be comfortable with has a lot of relation to my expectation of the future. That is so there is no concept of this is the value of this asset. It depends upon my assumption, it depends upon my perception, it depends upon my expectation of the asset, and that can significantly be different from one person to the other, and not necessarily every person is going to be right and not every person is going to be wrong. So that is the real gain. But even then, let's say we do some calculations and say that okay, the expected future price is 30,000. Now the question is, am I willing to buy at 16, 18, 90 index? Well, that depends upon what my opportunity cost is, right? So, for example, now what do I mean by opportunity cost is just the rate of return, right? So, if I'll just write the rate of return that I am already earning, okay? I'm trying to oversimplify at the moment, but we'll get to the advanced stuffs in a while, okay? So, the rate of return that I am already earning will decide by how much the future value I will discount it and get it back to the present. Okay. So for example, let's say my other assets are already generating a return of 15%. Okay. Now, how does this work? Right. So in order to explain discounting, how do I get the real price today? You have to understand the concept example out here. Okay. So let's say today we have 5 rupees. Okay. And that 5 rupees increases by this increment rate. Okay, so I'm just going to increase that by whatever increment rate is given out here. So let me just put up the formula. So the next year the value changes to 5.25. The year after that it increases to 5.775, and the year beyond that increases to 6.64125. So these are not the truth. I mean, these are just assumptions. So if somebody has got the expected future price, they have assumed certain increment rate, but at the end of the day, it's the assumption. How they arrived at that assumption is based on their own specific research, right? But this is not necessarily going to happen. It might happen, it might not happen, okay? So anyways, so 6.64 is the future value of 5 rupees after 3 years. Right? Now let's try to do the reverse calculation. If we were to know that okay, in year 3 the value is going to be 6.64125, then what is the value at 0? So we need to now go back, right? So in this case, what we are doing is, when we were trying to increase the value, we are doing a multiplication, compounding the value by the increment rate, right? In very simple terms, what if you have to represent this, is just that what we're doing is value into 1 plus the rate. Okay, all it means is, if you are saying 10%, then basically it has become 110% or 1.10. Okay, so that's all that is happening, because it can't be into 10%, because if you do into 10%, that means you're saying 5 rupees, 10% is how much, but you are trying to increase over and above 5, right? So if you're increasing over and above 5, then it has to be 100 plus the percentage increment, right? Now, if you go back, if you do the reverse calculation, it's exactly opposite. So if somebody asks me, what is the value of 6.64 at year 2, then I'm going to take 6.64. Now, instead of multiplying, I'm dividing it by 1 plus the decrement rate, right? Or the increment rate, whatever it is. For now, I'm just keeping it as simple as possible. So then the value comes back to 5.77, right? Then if we just extend the formula, then it becomes 5.02, right? Based now, obviously the value is different here because I've taken a different. If I take 10, I become 5.25, right? Now if I go back and if I divide that by 5%, because that is what the rate was there in this period, then I get back. So all that is happening is just a rearrangement of the algebra, if you were to say. And if you would like to look at the simplified version of the formula, then all we are trying to say is future value is equal to, okay, so future value is equal to present value into 1 plus r raised to whatever period that you are doing. Okay, since we are doing it for every period, we are not doing raised to 1 because it's obvious it's 1, right? Because we only be doing for one period. But if in case somebody asked us that what would be the rate of 5 rupees directly at year 3 based on 5%, then we could just use the same formula and say that okay, 5 into 1 plus 5% raised to 3, and we would directly jump to the year 3 value. But of course, these singular calculations don't really happen in modeling because every year the increment and the decrement rate can be different. Okay, usually in the increment rate, not really in the decrement rate, because decrement rate we're trying to discount. So the process of finding the present value from the future is called as discounting. And if you are increasing, then you basically call it as compounding. That's all that is happening, right? So by now, what we are trying to understand is just the discounting part of the discounted cash flow application. We will come to cash flow and then we will come to valuations. Okay, so first we are just getting the basic side. Okay, so if let's say now the discounting rate or the decrement rate which we spoke about here, right, when we are doing the reverse calculation, if that is 15%, don't really get confused about 15% at the moment. I will be talking about this, how this rate gets calculated and how it can be different for everyone. But for now, assume that 15% is what the discounting rate is. Then how do we find out the present value? Very simple. So expected future price divided by, as we discussed, 1 plus the rate of discounting, which is 15% in our case, and whatever the gap is. So if you see 2029 to 2022, there's a gap of 7 years. So I do raise to 7, and I should get this value as 11278, right? And if I just put the formula down, I should get the value in terms of for all the assets, right? So now, if 15% is the rate of discount, then all I'm saying is that even if the future is 30,000, based on 15% discounting rate, my assumption of the present value of this asset should be 11,278 in case of Nifty 50. Okay. In case of house, it should be about 0.56 crores. And if it was, let's say, Bitcoin, then it should be about 1,87,969. Now, you should try to notice something out here. In case of Nifty, okay, your derived expected value today, your assumption based on whatever 15% that you've taken, is actually stating that probably Nifty is a little expensive, so you're not interested in buying. Okay, and if you look at in terms of real estate also, then still you are saying that the real price is should be much cheaper, and the price today in the market is pretty expensive, so I'm not interested in buying. But in case of Bitcoin, okay, the value is different. If the value has this much expectation of increment, then you are saying that okay, the real price is pretty high. That means you are expecting that okay, the real price of Bitcoin today should be about 1,87,969, but it's for cheap, right? Now there are three factors that you need to be very careful out here, and these are the places where people tend to overestimate or underestimate. Okay, you understand there are three factors in play at the moment. The fact that current market price is true. So whatever the current market price is absolutely true, so we don't have to really worry about that. But the future expectation is also an assumption. This is also an assumption, right? How many years between you are trying to find out the present value is also the third factor. So out here, if I were to list down the difference between 2029 and 2022, the 7 years is a factor in deriving the real price. The second is the rate of growth for the future, assumption, is also playing a factor, because if this value is not 30,000, if the value is, let's say, 15,000, right, then the values are pretty different, right? And finally, the rate of discounting, right, is also in play, right? So if instead of 15%, if I use, let's say, 9%, then now you can clearly see that the real price is almost similar to the current market price in case of Nifty. The house is also pretty similar in terms of the real price and 0.85, the current market price, and if in case of Bitcoin, it is still increasing. Now, but in Bitcoin, we are expecting a lot more higher price, and hence the value today is higher. But if I say instead of this, it is just, let's say, 80,000, right? Then now the values are pretty different. So it's discounting and compounding and finding present value, intrinsic value is nothing but the effect of time, the expectation of risk of a company or an asset and your rate of discounting that you're using. Okay, so at the end of the day, it's all assumptions apart from current market price. Okay, now let's go to the fact that how do we decide whether to discount it with 9%, 10%, 12%, right? So I'll give you a simple logic. A very simple logic is all you're trying to assess is how much riskier is the asset in question compared to the general class of assets. So if you're talking about Titan stock, then we're basically talking about equity in general. If you're talking about a house, then we are talking about real estate in general. Okay, and if you're talking about Bitcoin, then we're talking about cryptocurrencies in general. So all we're trying to compare is an individual stock that we are analyzing to buy, comparing its risk to the entire class of security. So the entire class of security, if let's say we're talking about equities in general, they are risky, right? They are risky, they are not risk free. So whatever risk we are trying to measure is it riskier than the general asset class or is it less riskier than the general asset class? Okay, so for example out here, if you're talking about a Nifty 50 large cap equity stock, then the relative risk benchmark would be Nifty 50. If you're looking at a mid cap stock, slightly smaller companies, then the index for relative comparison is going to be Nifty mid cap, and similarly Nifty small cap in case of a small cap stock. These companies are very actually called small and big based on the value of the equity of the stock multiplied with the number of shares. Right? So HDFC is a large cap stock, Infosys is a large cap stock. Right? Now again, look at how assumptions keep on creeping in. Okay. Now, what you're trying to say is, okay, so what is the historical average returns of the equity large cap asset classes? So we're saying, okay, that's about 15%. Alright. So, but we're talking about historical. So we don't know what is going to be happening in the future, but we've made an assumption that, okay, let's calculate the last 5 years returns of or 10 years returns of Nifty 50, and that comes out to be about 15%. Then we already know what is the risk-free rate because that is the government bonds, 10-year government bonds rate, which is about 4%. Now we are asking that over and above what is free, because if I invest in government bonds, then there is actually no risk, right? Because government can always print money, and at least in terms of the stability of the Indian government, the expectation of default is very less. So we are saying that there is absolutely no risk in investing in government bonds. So when I am looking at Nifty 50 in general, equity as an asset class, then all I'm saying is that what is the excess reward for taking the risk of equity? So a very simple calculation for that is just to find out the difference between the historical average returns minus the risk-free rate, right? So what this 11% is telling us is we are getting we have an expectation. So you have to be very clear with what you're using, right? We have an expectation that by taking risk in equity, we are not talking about a specific stock till now. We're just saying taking exposure in equity in general is going to reward us by over and above 11% over the risk-free rate, right? So we found out the excess returns of equity in general, but we still left with the specific stock. Let's say we're talking about Titan stock. Okay, so we have to calculate how much is Titan riskier or less riskier compared to Nifty 50, right? So all that this 1.1% means is this 110%. Okay, people tend to complicate this a little more than what it actually means. Okay, so all we're trying to do is say that, okay, how much is Nifty, how much is Titan more riskier than Nifty? So if it says 1.1, then all I'm saying is 110% of Nifty 50, right? So now we are saying that, okay, if that is the case, then why don't we multiply? Because it is more riskier than the general excess return that we are getting. So how about we multiply the same percentage, 110% of the excess returns. Okay, so now you see my expectation Again, for the returns expecting from Titan is now higher because Titan is more riskier. If it was 1, then it would be same. If it is 0.8, less riskier, 80% riskier of Nifty 50, then your expectation of returns would be low, right? So all you're trying to do is excess returns adjusted for the risk of that specific stock, right? So let's keep this as 1.2 for now. Okay, so my basic expectation of excess return is 13.2, but hey, we also need to add the fact that risk-free was already 4%. So then what is my expected discounting rate or decrement rate or the opportunity cost that we spoke about is 17.2%, right? And if you did the same calculation for all of them, you'll get separate answers. So again, the assumption here is this is an assumption, right? This is not an assumption, right? So if this is an assumption, then even the decrement rate is an assumption, right? So you have to understand that even your rate of growth, future expected value is an assumption. Your discounting rate is also an assumption, right? And your beta is also very specific to the period that you are calculating. So you have to be again very careful on what period are you calculating the beta for, right? So that is the concept of this 9%, the discounting rate. Okay. So now let's move on to discussing a simple calculation which will show you how this calculation actually works, right? So again, the risk-free rate for ABC Limited is about 4.4%. The beta of the company is 1.2, okay, which means it is riskier than its general asset class. Okay. Now you might be asking this question: what do we do in case of a private company? Absolutely not a problem. What you could do is take a public company which has that price data available and then adjust it for the capital structure. But at the moment, I don't think so you require this because we're still sticking to the basics at the moment, right? Anyways, I have a video on beta calculations, proper manual calculations. If you would like to watch, I will put it in the description box in case you want to refer that. Okay. So the average returns of the index of the past 5 years, let's say, is about 15%. So what is my discount rate? So we just understood this. So let's find out the excess return over risk-free rate, which comes out to be about 10.6%, adjusted for the higher risk or lower risk, whatever comes out. So it's higher risk at the moment because 1.2, and then add at the end the risk-free rate again, right? There you go. So my expectation of the discounting rate is about 7.2%. So that is what I'm going to use to find out the present value discussion, right? Now let's say the business is generating this cash flows, and don't worry about cash flow, how to derive it, even that we're going to be discussing in a while. But for now, let's stick to finding the present value first. Okay. So now since we know the value of the discounting rate, so let's take the cash flow, divided it by 1 plus the discount rate, freeze the cell, and raise to the number of years to discount for. Remember, this is year 1. Okay, so year today is what we're trying to find. So today is always 0. So the present value comes out to be 3415, and I add up. Now, in case you notice that we're talking about present value of the business cash flow until year 6. So the answer to this present value of these possible future cash flows is the summation of this for the moment. Okay. However, now next question that comes up is that 17485 is the present value of the certain cash flows until year 6. The next question to ask is, if we are talking about valuation of a company and the assumption of a company as a structure is a going concern, which means, are we saying that the company is going to stop at year 6? Of course not. The company is going to function even beyond 6. Then how can we say that the business is only valuable till 17,485? Because that would be incorrect. Because then we are not adding any value to its future performance after year 6. Right? So how do we calculate? Because we can't keep on doing future prediction of the cash flow to perpetuity, because that would be crazy, because nobody can really see what's going to happen 200 years from now, or maybe 100 years from now, or from 50 years from now, right? So For now, our present value of cash flows until the 6th year, we know it is 17,485. But since the business is not going to stop after year 6, we need to find a way by which we are able to calculate even the value beyond 6th year, which probably I cannot predict. For that, you need to understand the concept of infinite cash flows. Okay, so I've given an example here. So Rohan offers Sohan 5,000 per year forever until eternity. So there is no time. It can be 1,000 years, doesn't matter. Okay. In return, if he gives him 5 lakhs today, so the question is, what should Rohan do if he is already earning 10% in his another investments, which means 10% is the discounting rate. So let's do a simple calculation which will show you how to derive this value very conceptually without remembering any formulas. Okay, so the cash which the guy is ready to give us is about 5,000, right? So this is 5,000 and he's ready to give us infinitely. So for now, I've defined infinite, let's say for 250 years, 242 years, right? Now, of course, we will use the same concept of finding the present value. So we take the value divided by 1 plus the discounting rate, the decrement rate, and raised to the number of years of discounting that we are doing, right? So in this case, it's 1 year, and then we will just double click this so that this calculation will keep on happening. Alright. So there you go. So it's going, and we'll just sum up this, all of the values. Okay. And you get 50,000. Right. So what exactly happened? Right. So let's see what exactly happens using this chart. Okay. So I'll just press F11. Now see what is happening. The cash flow finally is stuck at 5,000. Okay, if it's difficult to see this, then I will put this into a line so that you understand this better. Okay. So now you can see this 5,000 cash flow is constant. But since time is passing, you see what is happening out here, right? And I think you don't need this time as a factor. Yeah. Okay. So what is happening over time is the value of money is dropping because time is increasing and hence the value is finally moving to zero. Okay. I think this we can try to look at this a little more better by changing this everything into a line. Okay, yeah, so I think this is better, and I think we can do this again. Fine. So now look at what is happening to the gray lines. That is the value of money, the present value. It is slowly going to zero. That means after a certain value, after a certain time, the money value is nothing, right? You can see out here. So there is a possibility, there is a way by which we can predict the terminal value or the perpetual present value of a cash flow which is infinite. Now, of course, all the time you can't really do such 200 years calculation. So the simple formula for perpetual cash flow is to divide the regular cash flow like 5,000, which is going to continue, and you just divide that by the opportunity cost or the rate of discounting, and you will see that the answer is more or less same. So you don't really have to do this summation all the time. All you do is divide by the rate. But what if I change the scenario and I give you a new scenario in which the offer is same, however the 5,000 will be growing at 5% every year, and the offer is still same, pay 5 lakhs. In the first case, by the way, we will reject it because it's just worth 50,000. Right? Now let's take the 5,000, but instead of keeping it constant, we're going to increase this by 5%. Now you should be able to slightly estimate that since this cash flow is going to increase, right? It is going to take slightly longer time for it to approach zero. Okay. Now the competition is actually between whether if the present value should increase or not is based on which wins. Okay, is the 10% going to win or the 5%. So it's going to be a battle between the growth versus discounting. So now you can see that although the cash is definitely increasing, right? Because it's 5,000, which is increasing at 5%. Unfortunately, the value tends to decrease because you're discounting at 10% while you're increasing at 5%. The battle really finishes. Although late, but yes, it tends to extend to about 120 years, 90 years before it actually becomes zero. But in other case, if you see the previous case, about 50 odd years or so, the value directly goes to zero, right? So now it should bring you to the question that what is, in terms of valuation, when we're looking at perpetual cash flow, you have to be very careful with what the perpetual growth rate you are taking. Because the growth rate, right, in this case, if you see, we had taken an assumption of about 5% growth, right? And okay, by the way, let's just find out the value first by summing it up. So the present value will come up to be 99,998. In your previous case, it had come to 15,000, right? Now, let me also show how this can be done without doing such calculations, right? So, present value again, without obviously doing the manual calculations, okay? So, what we will do is, we will take the last year's cash flow, which is 5,000, which is going to grow. Now, in the previous case, we just divided by the rate. But in this case, we will increase it by the 5%, right? In the previous case, we just divided by the discount rate. But in this case, we're talking about 10%, which is the discount rate, but we have to reduce it to the 5%, right? Because how can we discount by 10% when the cash flow itself is growing by 5%, right? So the discounting rate will take a hit, which will increase the present value. Now you might say that there is a difference between the value. Yes, there is. But if you see this formula, even if you are talking about valuation, the values don't necessarily have to be exact, because everything is an assumption at the end of the day, right? So even a very close estimation, right, between these are a good estimate. So there's only a difference of about 5,000 rupees, which comes in manual calculation versus a formula. And by the way, there could also be the difference because we have just stuck to about 240 years, because it is still not zero, right? So if you extend it to, let's say, 1,000 years, then probably these values will match, okay? But now you see, if I just increase this 5%, okay, so also let me put this into formula. So now, what I said at the beginning was, you have to be very careful on both these values, the discounting as well as the perpetual cash flow rate. It is okay to be wrong for 5 years of prediction of your company's future cash flow, but if you go terribly wrong in terms of taking the perpetual growth rate assumption, values will be changed. So if you can just look at how these values change, I will show you the stark difference in the value that comes up when we are not careful about this growth rate. Okay, so let's say that what would happen in case of a 2% perpetual growth rate cash flow, and let's increase it by, let's create a series of different perpetual growth rates which can be assumed. And I've seen a lot of analysts, because they just want to come, the stock is in demand and you don't really want to be terribly wrong, so they will try to assume a higher cash flow, right, or higher perpetual growth rate. But let's say, so I'm going to make a data table, a one-sided data table, okay, because we don't have really a second dimension out here. So let's take, or actually we could take the discounting rate also as the second dimension. Okay, so let's say the discounting assumption is 10 and we decrease it or we increase it by 1%. So we create different scenarios in both the sections. Okay. So now we will create a data table to see what exactly happens when we are assuming different kinds of discounting. So above will be discounting rate, and out here will be the perpetual rate. Okay, so that's our quick data table out here. Let me select the data points. Now let's go to data, what if analysis, data table. Now row input is the discounting rate, so I'm going to select this, and column input is growth. This is how the data table would look like. Okay, so see what exactly happens when you are assuming a very high perpetual growth rate, your values will increase significantly, right? So it is very easy to go wrong with your perpetual growth rate. So if let's say you are assuming only 2% and the value comes up to about 62,000, the perpetual cash flows, right? If you're assuming, let's say, a 4% and it's about 83,000. So how significantly the value can increase is tremendous. So you have to be careful with your perpetual assumption. So this is how you estimate the infinite cash flow, right? Moving on to the second last topic of the concept is, okay, we understood what is discounting, we understood what is present value, we understood what is infinite cash flow, but what about what to discount, right? Because finally we have to discount something, right? So the logic of that is explained out. So if you see, when we are talking about value of the business, okay, so we don't really mean equity, we mean value of the business, which includes equity and debt both. A very easy way to understand is when we are trying to understand the value of the business, when we are talking about equity and debt funding both. So if a company is funded both by equity and debt, we are looking at what is the value of the firm. Versus when we are looking at value of equity, then we are saying, okay, what is the equity cash flow and what is the value of only the stock equity. We're not talking about the firm. And a very different perspective to again look at this is when you go and acquire a company, you have to pay for the debts as well as you have to buy the equity, right? In case of when you're just buying a single stock, I don't really have to buy the debt and take care of the liabilities as well. I just buy the stock, right? So in case of value of the business, we are looking at FCFF, free cash flow to firm. When we are looking at value of equity of the business, then we are looking at just free cash flow to equity. In real estate cases, most of the times we are referring to FCFF because we usually do not buy real estate more so with equity. We use a lot of debt funding. So that's the time and we will need FCFF. Value for land, because land is most likely not funded through equity, through debt. Hence, FCFE will be needed. But what is FCFE? Right? It's the cash which gets generated. It's the expected cash that gets generated in the future, which will finally increase the value. Right? So in valuation, there is no concept, okay, of your receivables or your paper earnings. It has to be cash. Okay. So let's give an example out here on calculating FCFE with income statement and balance sheet and cash flows. I'm going to quickly do this so that you do not get confused. Right? So let's say we are talking about the value of equity out there. So how do we start? So simple. We're going to start with net income. Okay. Because net income is not necessarily cash. So we're going to add out the depreciation. So minus, because all the values are negative out here. So I add the depreciation, which is a non-cash charge. Okay. Then we are looking at, so if net income plus depreciation is 137323. Now the next question arises is, what is the revenue and payments which are not in cash? Right? So out here, if you already have a cash flow statement, you really don't have to do that, because you could directly take the CFO, which is net income plus depreciation plus the loss in non-operating income. That would give you the cash flows from operations, right? And it's already calculated 2571, right? So what would be the free cash flow in that case? Would be the cash flow from operations, okay? Then the capital expenditure, okay? Whatever equipment you are buying. So in this case, you can see the equipments that we are buying. We cannot consider investment as capital expenditure because investment is surplus investment. We are talking about assets being bought for the business. Okay. Then we can reduce. We will not even reduce the deposit because deposit tends to come back. So it's not really an outflow permanent. Right? And if you just do this much, then that should give you cash flow without repaying of debt. But if in case you are an equity investor, you are talking about cash flow which is available to you after repaying the debt holders, and hence you will also talk about the repayment or raising of debt. So that is FCF. In case of FCFF, you will have to take EBIT, okay, post tax. So it will just be the operating profit post tax 1 minus the 30%. Now the reason why we are taking EBIT is because interest is a part of the cash flow for the debt holders as well. So it doesn't make sense to reduce that, right? So we have taken EBIT post tax, then we will add the depreciation, and then the calculation is very similar. So the loss and non-operating activities, we will add it back, okay, and then we have the working capital changes. Working capital changes are nothing but all the revenues which are not received in cash. We have to find out how much is the cash. If you have paid salary, you have delayed the expenses for salary that you will pay later, then that has to be again accounted for cash. So I'm not going to really spend a lot of time discussing that at the moment because it's beyond what we are trying to learn here. And then we go to the purchase of capex, but we do not go beyond this. We stop here, and which gives us the FCF. So even when we are talking about the future, we are talking about predicting the future income statement, balance sheet, and cash flow of the company, deriving the free cash flows, and then again using the same concept of discounting to get it back. That is what is finally discounted cash flow valuation. Okay. Now, I know I did a little faster out here in terms of what to discount because I already have a video on creating income statement, balance sheet, and cash flow. So you can refer that. Now let's skip and talk about model. Okay. So this is a made model because we are not really learning how to make a model, but do valuation. Okay. So out here we've got the predicted values of the company's cash flow, profit and loss, and balance sheet for 2020 onwards to 2023, and we are expected to find the value of this business. So the concept remains same. We need to find FCFE. Okay, and all the other assumptions for valuations are already given. So let's start with year one. So we want to find out the FCFE. So remember, we can directly go from cash flow statement also. So the total operating cash flow, as you can see, is about 1470. Okay, then we are looking at capex. So we will do plus capex. Then dividends we really don't have to consider because dividends are part of cash flows. Right now out here we can clearly see capex is done. Change in debt. So repayment of debt is what we have to consider, and that should give us the FCFE. Okay. Okay, and 2024 there is nothing, so that's year 4. Now, similar concept again, we need to find out the present value of these cash flows today. So cash flow divided by 1 plus the rate. Now we need to find out the rate. Okay, it depends upon what we are trying to find out. Since we are using FCFE, we need to find out the cost of equity. So we can find the cost of equity simply by doing RM minus RF. Okay, raised to multiplied by beta plus 5%. Okay, so that's about 14.8. So let's discount this by 14.8 raised to value. So that's my present value. But remember, again, the company does not stop at 2023. So what do? We have to take the perpetual cash flow growth rate. Okay, so we will have to, in reality, depending upon the business type, you have to assume a perpetual growth rate. Generally, the best practice is to take the world GDP growth rate, which is about 2%, so that you don't go terribly wrong. It's okay to have a conservative value, but it's not okay to have an optimistic value, and then while you are actually expecting the stock to increase, you see that it does not increase because you have gone terribly wrong in your calculation, right? So it's better to be conservative. So we can take a 2% perpetual growth rate, right? So 2%, and remember, divided by the discounting rate, which is KE, minus the perpetual growth rate, right? So that gives the perpetual value at year 4 for all the forward years that are going to happen. But we still need to find out the present value to 0, right? So let's first do the present value of from year 1 to year 3, and then let's find out the present value from 2024 back to year 0, which is 1 plus the KE rate raised to 4 years. Okay, so now that's the terminal value for. Okay, I'm so sorry about. I have to put this up here. I have to put this out here. So my total equity value now comes up to be as the summation of these two, which comes up to be 11,077. Right now, if you had number of shares, okay, let's say you have number of shares which were given to us. So let's say it was 500. Again, just making things up. So the intrinsic value would be the value divided by the number of shares. So that's the price of the stock. Okay. What if it was FCFF? So let's do that. So FCFF, we will have to start from EBIT. Okay. So let's start from EBIT. There's our EBIT into 1 minus. Now I'm just assuming 30% tax. So EBIT post tax plus if the depreciation is given a minus, so we just do minus. Okay, so that's the adding of depreciation. Now we will take care of the change in current assets. So it's already given. Change in current assets and liabilities already given. So we just quickly sum up that both together. It's basically the working capital change. Okay, and that's a free cash flow. So you can see that the FCFF is obviously going to be higher than FCFE. And now again use the same concept of finding the present value, which is divided by 1 plus. However, before you go forward, you can use cost of equity. So you will have to find WACC because we're talking about equity and debt both, right? So first is to find out the proportion of equity and proportion of debt. So if I divide this together, I will see that 64% is equity and 35% is debt. Okay, and the proportional cost is K, we already know is 14.8, but debt is what we need to find out. So for now, for the sake of the assumption, I'm saying it's 9%. Okay, so in that case, what is going to be the WACC? So let's find out WACC is going to be just the proportional multiplication of 65% with cost of equity. But in case of debt, you have to also take care of tax. Okay, so 35% into 9% into 1 minus 30%. I'm using hard coding in case of taxes because in the interest of time, I'm trying to be a little simplified, but in your real case, you should keep your tax rate separately calculated. 30% you should write it something. Okay, so now since we have the WACC, we just divide the cash flow by 1 plus the WACC rate raised to, again, the same similar concept till 2023, but we have to find out the perpetual rate. So into 1 plus the perpetual growth rate of 2%. Okay, divided by the WACC minus the growth rate of 2%. Okay, I take that. So that should gives us the perpetual terminal value at year 4. Again, find out the present value of the terminal value as well. So divide that by 1 plus 11% raised to 4 years and add that up. So that's the value of the firm. So what we are saying is that the value of the firm includes the debt and equity both. Okay. Now, for the purpose of calculation, I've shown you this, but in reality, we actually use FCFF and then derive the equity value rather than going from equity to enterprise value. Okay, so that's why there's a difference between the value in both the cases, because out here I'm using a higher discounting rate and then in case of WCC I'm using a lower. Okay. So that's how you actually do a valuation. But now, since we are saying that there are certain things, so many things which are assumed. So how do we, how does an analyst become comfortable with, seeing, where these assumptions are lying? Okay, so a simple thing that every analyst will try to do is whichever valuation calculation he has done, he will try to create a data table on the various assumptions taken. Okay, so let's can create an assumption of cost of equity. So in our case, of course, we have taken the cost of equity of 14.8, and we can create a scenario where what if the risk of this company is higher. Okay, so then we can create certain ranges to see what exactly happened if the cost of equity was high. Okay, because we're really not interested in finding the optimistic value, we are interested in finding conservative values because we want to see where we can go wrong. Okay, and we can compare that with another big assumption, which is the perpetual growth rate, which we already know. So in our case, we've taken 2%. Okay, so maybe we try to go from, let's say, 2% all the way up to 0.25% increment, and see that what exactly happens if in case the perpetual growth rate changes. So we have got about 7 assumptions here, and we've got about 8 assumptions here. So we'll just remove the rest out here, and let's put the perpetual growth rate. Okay. Of course, it's not necessary that you have to stop and test only these 2 assumptions. You can test various other assumptions like beta as well. But I'm just trying to show you, the usual things that a person does. Okay. Now, what are we trying to find out? We're trying to find out the total equity value. Okay. So we're trying to see, or we could, instead of equity value, which would be higher, we can directly talk about the stock value. So this is the stock value, 22.15, and we want to find out what exactly will be the stock value if these assumptions change, right? So every analyst will try to find out a range of things which can happen if the assumptions are really bad. So row input out here is perpetual growth rate. Okay. So the perpetual growth rate is out here 2%. And in case of the column, we have the cost of equity, which we see what values we get. So there you go. So, and you are always welcome to change the values and see what exactly happens out here. So if you can see out here, if instead of going from 14.8 to 3.5%, if I do, let's say 6%, you can see how the values will change. So it is one end you are talking about 22, and the other hand you are talking about 30. So you have to test out various assumptions that you are taking, majorly cost of equity and perpetual value. So that exactly is discounted cash flow calculation, and I hope, I know this video is long, but it is intentionally long because it is not possible to teach all of this in a 20 minutes video. So I hope this video helps, and I hope this concept is clearer for you in the future. Let me know in the comment box what you think about. If you have any questions, I'll be happy to answer, and I'll see you again next week.